We're so glad that you're with us. I'm here with Dave Hall, the prosperity guy. Dave, welcome to another episode. It seems like we're getting along better now that we're together.
Yes, we are. It does seem like we are. I really missed having you last week.
So how was it? I mean, I did catch a glimpse of the show, but I was feeling pretty crappy last week.
It was lonely. It was lonely. I didn't have a lot of interaction. You weren't here, so it was a little lonely, but I think we did okay. We got a bunch of questions answered. I at least got it launched a year or so ago when I tried to do it by myself. I couldn't even get the thing launched. So we're making progress.
Yeah, I'm so glad you were able to get it going, get everything up, and even to have the questions come up. I was really excited when I see new questions come. So I feel like we're improving, and you're gradually accepting this technology as we go.
Yeah, don't expect me to take over anytime soon, though. I'm just happy to answer questions. That's what I'm good at.
Yeah. Well, for those that are watching live, we're so grateful that you're here. Thank you for being part of this. And those watching on replay, thank you for being part of this show. What the show is about is we come on and ask Dave as many retirement questions as we can. We just throw all these questions at him and everything from every situation, from webinars they've been a part of, questions that come in through email, questions that come in through Facebook or YouTube. And we encourage you to submit your questions as well. As you're watching the show, if you have a question or something on your mind, it could be reverse mortgage, it could be Medicare, it could be Social Security, it could be anything, Dave. And I don't know how, again, you store all of this in your brain. It just completely astonishes me how you do that.
Just try to compartmentalize it, but we do our best. There are things that we forget at times as you look at the amount of knowledge we've got to cover, but usually we can find the answers for people if we can't answer them directly and get you on the right path of where you need to be heading.
And just a special announcement, Dave, you and I are actually going to be doing this together next week in the same location.
We are. It's going to be unique. We've not had that opportunity ever, I don't think, since we've launched this show. We've been close to each other, but I am excited to be in the same place.
Yeah, so it will be fun. So again, if you're watching live, go ahead and submit your retirement question. Anything on your mind, anything you're thinking about, you're contemplating, saying, oh, should I do this or that? Jump on and let's see if Dave can answer that question. In the meantime,
and real quick, CR though, with you coming next week, my boys wanted to know if you wanted the 2-man or the 4-man tent set up out back.
As long as there's cushions about this high, I'll take whatever you have.
And should we turn off the sprinklers or should we let those just keep going?
You actually have sprinklers in Tennessee?
So we have them. We don't use them. Usually we do during the middle of summer at times. We do use them. But no, we've got a bedroom set up for you. You'll be taken care of. My boys are excited to have you come and visit.
I'm just so glad that as long as it doesn't rain while I'm out there, because if you're from the South or been caught in the rainstorms out there, they last 10 minutes, but it is the most torrential downpour I've ever felt.
It definitely is, but I'm afraid to tell you, we've had rain pretty much every week, so I don't think you're going to get through the whole week without it, but hopefully it won't be too bad. We can get out and do a number of things.
Yeah, no worries. Well, Dave, I wanted to start off and talk about the power of zero this week. I know we touched on it a couple weeks back in some different areas, but the power of zero, let's dive into it and break this down before we start answering questions, if you can help us.
Yeah, it's interesting. This is kind of where we got started. We originally started educating on retirement because of David McKnight, who is the best-selling author that wrote the book, The Power of Zero. But even this week's webinar or podcast, I went back and talked a little bit about tax rate risk because something we haven't done for almost a year, CR, in our podcast even. So what it is the desire to get to a 0% tax bracket in retirement, believing that tax rates are going to be substantially higher in the future than they are now. So it's a great opportunity for us to take advantage of some historically low tax rates, make some adjustments in our retirement to get us to a point that we can take that risk off the table of tax rates and enjoy our retirement without having to worry about how much our partner, that silent partner of the government, is going to take from us.
And it's really important too that we let you watching today that I think we're just in episode 80 out of our 2 seasons of the podcast. So we've had so much knowledge out there. We've got all the information here as well. And I think it's really important. And looks like Gary's already jumping on saying, welcome back. So I had my COVID shot last week and it kicked my butt, but now I'm back and And Gary's even saying good morning, Dave. So he's probably what, just barely waking up and eating his chocolate over there in San Francisco.
Yeah, good morning, Gary. Yeah, a little early over there, 9 o'clock. Although he's always on webinars that I'm teaching at 8 o'clock here. So Gary's got to be an early riser because that'd be 6 o'clock for him, and he's up and at it.
That's awesome. Well, Dave, as we talk about the Power of Zero, let's get in because a lot of these questions come from that. And I wanted to start with Martin's. And he's asking, if your assets are in a trust, will spend down still apply when considering Social Security coverage?
Yeah, so I'm not sure when we look at this question, Martin, I'm not sure that what you're exactly getting to. There's some uncertainty here. Now, if you're looking at a living trust that's got money, so it's inside of the taxable bucket, and we're looking at Social Security itself. I mean, Social Security is not based on income. Now, the taxation of Social Security is based on income. Trust's not going to affect that at all. So I apologize. Really don't fully understand your question here. Wish you were here to be able to do a follow-up, but really trusts have no impact on Social Security.
Dave, how hard is it to be able to give advice on retirement when people are just throwing questions like this at you, where you're just getting just a small snippet of it?
Yeah, it can be a little challenging. And I had one last week. In fact, a lady had said she was going to join the show. She'd send a question, and I answered the question by an email. I sent it back. Well, then in a follow-up question to it, she gave me some more information that changed the answer. It all of a sudden became a whole different answer into regards to what she should be doing. And so that's the challenge we have, is oftentimes we're not getting the full story. I've had those situations where I've done a planning session and went through and we put a plan together, and then all of a sudden someone says, I forgot to tell you about this pool of money here, and I forgot to tell you about that investment there. And all of a sudden you start having issues because what you thought you were talking about wasn't at all what was really going on in their situation.
And I think it's really important that as we focus on this, Dave, that we try to help, because every situation, like you said, is different. But if we can just kind of at least give people a snippet to get through this, I think it's going to help. Uh, one,
Absolutely.
one of the questions I wanted to bring up here from Laura: how did anyone survive with 94% tax? If you remember teaching about this, maybe give them a little background of what this is about.
Yeah, absolutely. So this was the highest tax bracket in the history of America. That was during 1944, 1945. Ronald Reagan was in this bracket. As a result, he only made 2 movies a year. Anyone making over $200,000. So one of the things you got to remember is that's like over 3 million in today's dollars. So no one was struggling once they got to that point. But that being said, there were a number of steps inside of their CR, meaning there's like an 88%, an 82%, a 76%, whatever it may be. So yeah, if you were making into $1 million plus in our day and age, probably like 75, 80 grand back then, you're giving most of it to the federal government. So yeah, it was really difficult for those people from an investment asset keeping standpoint. Now, as far as being able to survive and live and be able to pay their bills, I don't think many of them had that big of an issue because of the sheer amount of money that equated to.
Yeah, I can definitely see why Ronald Reagan only did 2 films. Because again, when you're looking at tax rates like this, it's ridiculous.
And even on that second one, CR, again, much of that would have been above 70%. So even there, and living in California, he still would have had to give up some to the state of California. So he was still only keeping a very small portion of that second movie that he was doing.
And Dave, I want to bring up Mike's asking some great questions. So I want to pull up some of Mike's questions that are coming in live. So again, remember, if you have any questions about retirement, go ahead and submit those and we'll get those into Dave as well. I just have a list of questions that I throw at him, and I love taking your questions as they come in live. Dave, Mike is asking, can wife, almost full retirement age, get 50% of husband's Social Security money and is still working, and will payment be reduced?
Yeah, my couple of things to know here is that work affects both sides. So, meaning, Mike, if you were to be working and your wife was, and you weren't full retirement age, and your wife was expecting to get 50% spousal benefits, those would be reduced for both her and you. On her end, if you've already hit full retirement age and it's just your wife that's working before she hits that point, her benefits will be reduced including any spousal benefits that she's receiving. So they will be packed on later on. She'll be able to get those benefits back, but they will be packed on. And if you do claim prior to full retirement age, you would have a reduction that's going to be less than 50% as well. So hopefully that makes sense, that really if someone's still working up until full retirement age on either side, probably not a big advantage take Social Security because the limits are so low now. I think it's almost $19,000 is the income threshold for 2021 that you've got to stay under. Now, in the year they reach full retirement age, that threshold changes. We're just over $50,000. So maybe they want to look at taking benefits there, maybe just slightly under the full retirement age, but definitely things we've got to look at. And those benefits are going to get reduced by work until we hit that full retirement age.
And Dave, before I get to Mike's next question, I want to bring up that you've been doing so many webinars. You've been part of all these great webinars. One of the ones I wanted to point out specifically was one you did with Tom Hegna, and it was Paychecks and Playchecks. I know you've got another one coming with him, but I also want to let those know who have not seen that webinar, Paychecks and Playchecks. You'll be doing that again on May 21st at 4 p.m. Eastern time. I bring that up, Dave, because that really talks about annuities. But before we get into it, tell me that experience you had with Tom and going over that webinar, Paychecks and Playchecks.
Yeah, anything with Tom Hegna is great. And it's amazing because he's a ball of energy. He does 200 to 300 presentations a year. And we had an absolute great time. And it was great information. It's based on his best-selling book, the Paychecks and Playchecks. The new presentation we're doing is called Retirement Alpha. Now, that seems maybe a strange title, very confusing to people. But what it's talking about is the importance of annuities in retirement, that we're in a period of time that what we find is that if you take any retirement plan, and Tom challenges anyone to do this, he educates, he doesn't plan, but he says, look, give me your absolute best plan without annuities and insurance, and I'll put together a better plan by using these products because they help replace bond portfolios so well. They provide additional benefits with the death and survivor benefits. So yeah, it's just a great opportunity. I love Tom Hegna and I've enjoyed our friendship. I look forward to this upcoming webinar, the redo of the Paychecks and Playchecks, as well as the additional webinars we've got planned. We've got a bunch of stuff planned with him.
And Mike and Gary, I'm hoping to see you guys May 28th at the Retirement Alpha, using annuities to improve your retirement. Again, you can find all of these webinars at theprosperityguy.com and click on events. This one will be 9 a.m. on the 28th of May, and that will be the first of that class. But Dave, I bring all this up because Mike brings up a great question where he's asking, are annuities in your taxable bucket?
Before I answer that, let me throw something back out to you, Mike. If I did not appropriately answer your Social Security question, to make sure you understand that, please throw a follow-up question. We'll address that as well. But on the annuity side, it depends. You can put annuities in all three buckets. Most people have them in the tax deferred, so they've used their IRAs to buy annuities, but you can have them in your taxable bucket, you can have them in your tax deferred, and you can have them in your tax free, something that very few people have done in the past, but that we encourage people to do. I do a presentation called Tax-Free Income for Life, where we show you how you can take those annuities, put them into a tax-free environment, and get that guaranteed inflation-adjusted lifetime income for the rest of your life. But yeah, it's all three buckets. Now, one thing everyone listening needs to understand, if you do put an annuity in a taxable bucket, if you take money out prior to 59.5, there's a 10% penalty. It's very confusing because most investments in your taxable bucket, you would not be subject to an early withdrawal penalty, but they do that on annuities. So be aware if you're doing it outside there. If you're putting it in your tax deferred account, you're used to those rules. But if you put one in your taxable bucket and pull money out early, you would have some issues there with the early withdrawal penalty.
And Mike, if you have any follow-up questions, like Dave said, please go ahead and submit those, especially on your Social Security question or your annuities, because again, some of these get pretty complex. We won't be able to get into everything, but if there's things we can touch on, Gary's great at doing follow-up questions as well. So I haven't seen a lot from Gary yet this morning. So he's got to get through his Ghirardelli chocolate first there before we get too far. All right, Dave, well, let's jump back over. I wanted to bring up this one again. Some of these are so long. I apologize. I can't fit everything in and all the names. But this one is, I'm single, 40-year-old person who cannot contribute to a Roth IRA. Earnings exceed the limits and has $350,000 in a 401k plus $300,000 in a brokerage account. Should I look to transfer some to a life insurance retirement plan?
I think there's a couple of things you should be looking at now, based upon your situation. Life insurance retirement plan may be a great option to get money into the tax-free bucket, and I definitely would encourage that based upon what you've told me so far. But the other thing we want to look at is getting the money into Roth accounts through conversions. Again, at age 40, see, that money's probably, I mean, if you look at a 40-year-old and let's say you're making about 7% per year on that investment, every 10 years, that money's going to double. So if we take age 50, now you're at $700,000. At age 60, you're at 1.4 million. You're way over the thresholds of where we recommend you should be. Same with that brokerage account. If you've got 1.2 million at age 60 that's throwing off dividends and interest, you've got some tax issues. So yes, you really want to look at where you're at. You want to look at the future, and even for people in 32% brackets, I think what you're going to find when we look to the future, and especially a 40-year-old, that there's a really high chance you're going to be above there when you get into retirement with all this excess debt we have.
Dave, what happens if we keep everything like this in one bucket and we don't diversify? What happens to us?
Well, the biggest issue you have is you've got tax rate risk. You've got a situation where no matter what the government decides to increase taxes to, you're going to end up paying that if you want to stay within the laws. And that's the problem that we have. In my podcast this week, I went back and addressed these issues. We talked heavily about the national debt and the effect it's going to have. 2026, CR, many people, there's a portion of the population will go up 9% on their income. Most of them it's 2 or 3, but portion will go up 9%. That's the start before we address all this other these other shortfalls that we have. So yeah, it's something people have got to look at. I think they're fooling themselves if they think that tax rates will stay similar or have very few increases. Every government program is financially struggling that is of any significance, and we've got to figure out how to pay for it. And they're not cutting spending, so that leaves the option of increasing taxes.
And Dave, like you answered for Nadia here, this life insurance retirement plan can be very powerful, but again, if it's not well executed, then she's on a whole different path. And I think that's one thing that you're getting your point across, is that we have a lot of things we can do, even though the government and a lot of things around us are struggling. But if we have a well-planned retirement, I think we'll be able to really get through this without so much struggling on our end, I would say.
And I'm not telling someone to do this. Now I'm going to walk through a situation, but if you looked at it, you say, okay, she's a 40-year-old. We want about 40% of our assets principal protected. So we look at about maybe $240,000, somewhere roughly in there, that would want principal protected. And again, I would want to go through the whole situation, but for her to be able to take some of that cash and put that amount over time into a life insurance retirement plan wouldn't be a bad idea. I mean, yes, if we can use Roth accounts, we try to take advantage of it, but that money is going to grow tax-free for the rest of your life. It can be used, again, at 40%, you're basically replacing your bond portion of the portfolio. So the rest of your assets can grow faster. You've got, if taxes go up 1%, you're a win. You're in a better position. So yes, there's a lot of options to take care of the situation you're in now. And great question in regards to things you should do.
So you're saying just don't put my money in the bank and wait.
Yes. Right now, unfortunately, I know there's many of us that have way too much in there because of what we expect the market's going to do. But yes, long term, we definitely don't want a bunch of cash, especially in an environment where it appears we're going to have some hyperinflation. That's going to create some real issues with the buying power of the money we do have.
You're exactly right. Dave, Mike submitted a follow-up and he said, thanks, Dave. For question number 1, answer was good. So wife will wait until full retirement age late this year and take 50% after that so she can continue to work and let the Social Security Administration continue, or let her Social Security account continue to grow.
Yeah, Mike, I think that's a good recommendation. The only thing, remember when we look at this year, you would have a $50,000 income limit for this year because she's reaching full retirement age. But if you can get to full retirement age, not such a big difference. And there you're getting the full benefit, and that's going to continue on until one of you passes away. And then at that point, she or you, whoever's left, will continue with the higher benefit that you're getting based upon when you claimed.
And the other question that came in from Mike is, he said, Dave, what options are included in principal protected investments?
Yeah, so when we look at it out there with life insurance, retirement plan is one. So you're in a situation there that you're going to have to buy some life insurance to be able to take advantage of that. But it can be a great way to structure an asset that doesn't lose money. Now, all permanent life insurance is not designed for you not to lose money. I will say on a whole life policy, you're not going to lose money, but many of those policies don't keep up with inflation. So in theory, you're losing buying power every year. On a variable policy, you're going to have some issues because if the market goes down, you will lose money. You've got to get an indexed universal life policy. Annuities, the same way. They've got variable and indexed annuities. If you look at the indexed annuities, can be a great option. Then there's also some bank notes out there. You can do a structured note with a bank. I will tell you that they're based on the bond market. So right now you're going to get very little return, but there are structured notes that you could do if you chose to do so. But right now, again, if you're looking to keep up with inflation, I wouldn't recommend them at this point. Been times in history they've not been a bad situation, but for right now, what we find is really using annuities and life insurance to help provide this protection.
Great. All right, Mike. Hope that answers your question again. As we're getting through here, I really want to make sure we're diving to what you really need out of this. Dave, I've got one from Gary here, and he's asking, please elaborate on the piecemeal internal Roth conversion annuity, which you referred to in one of your webinars.
Gary, thanks for asking this question. I think it's something that we need to make sure people really understand how they work. Now, we've got a couple of issues we're trying to solve here. When we look at it, we've got to get money into our tax-free bucket. Problem is we've got taxes rates that are going to be too high if we do it all at once. So no one wants to take a lump sum and do it all in one year if they can help it. You want to do it over a period of time. Well, then you've got annuity companies, the majority of them, that say, look, we're not going to allow you to purchase annuity and transfer it in phases. You have to do it all at once. So you've got a situation where you're either going to have to buy a bundle of small annuities so you can move them slowly over, or you've got a situation where you're going to have to do a conversion of a very large balance, which you don't want to do from a tax side. So 4 companies that we know of have come out and said, look, we will allow you to do it over time. So you can take your bucket of money in your tax deferred account. You can buy a large annuity, whatever you need to be able to cover your principal protected piece. And then we will allow you, when you do your conversions into a Roth, to move that portion of the annuity over until you've moved everything over into that annuity or over into that tax-free bucket to where you can then take advantage of a tax-free annuity. So again, not something most companies do. In fact, some of the companies we work with don't do this. And times we have to do multiple annuities because people are looking for a high performance or something that they're wanting a different annuity than the companies that we normally would recommend. But that's how they work. And hopefully that helps you understand it. But it is a problem for most people to get into the tax-free bucket with annuities if you don't have this internal Roth conversion option.
And Gary, I hope that answers your question. And again, we're always here. We've got about just a little under 10 minutes left in the show. So if you have a follow-up question for that, if that's something we could explain a little bit more, we'd be happy to have Dave break that down. Let's hear. He's got one more coming in for you here, Dave. Gary's asking, which insurance companies offer the PIRCA?
So one of them is Allianz, which we do a lot of business with Allianz. Allianz is one of the 5 largest companies in the world. I mean, it's not just insurance companies. They're by far the largest insurance company, but they're truly one of the largest companies in the world. Pacific Life is another one, Lincoln National, and American Equity. So those are the 4 companies we know of. There may be others that we're not aware of. More companies are realizing the benefits of this. So we are seeing some transitions, much like when they first started offering the free chronic illness rider. Many of the companies was new to them. They hadn't figured out how to calculate it into their model. They've now changed. Most policies, you can get a free chronic illness rider. Same thing's going to happen here. I think you'll see more and more companies allow the conversion, but those are the 4 that we know of at this point.
Dave, how important is education when we're looking at something like a piecemeal as we're putting this together? How important is it?
Well, it's huge because you got so many moving parts. I mean, again, we're trying to get to the right principal protected portion. We're trying to make sure we maximize tax rates. We're oftentimes dealing in a situation where we can't get access to all the money. Maybe someone's still with their current employer and they don't have in-service distribution, so we can't touch the 401k plan. So it becomes very important to do some educating and to get some knowledge and put plans together, because what we've got to do is map out what this is going to look like. We've also got to look at Medicare. What's going to happen to Medicare premiums? So Mike brings up questions with Social Security. Now, conversions aren't going to affect your Social Security, but earned income can. So we oftentimes are trying to look at, when people retire, when they start taking benefits, what money they need. Very critical. I mean, you can make money. I had a situation the other day, and it was really sad. A lady had sent me back, and she says, "Dave, you probably noticed I was crying on the telephone or on the Zoom call," which I had. She says, "I've worked my whole life, and what you're telling me now is I'm between a rock and a hard spot. I've got to catch 22, because we're telling her for her to make her retirement work, she can retire today." But she looks at it and says, "Wait, but if I don't, then I can't get rid of tax rate risk because all my money's in my 401k. I can't get rid of market rate risk because all my money's in the 401k. I can't get it into annuities or principal protected product. So now you're telling me that my retirement's potentially going to look worse if I don't leave my job today. And yet I've spent my whole life preparing and I don't want to quit working." Well, I went back to her and I said, "Look, I feel bad that we put you in this position, but remember, you've made good decisions. You're one of the few Americans that what we're telling you is you can retire if you want to. Your retirement's going to last no matter what you do." And that's what we told her. I said, "Hey, if you add a few more years, yeah, maybe you can't take tax risk off the table. Maybe you can't take market risk off the table. But guess what? You can make a few tweaks. And regardless of how it works out, the models we've run for you based upon your income needs, you still have enough money." So yeah, it's not the perfect plan we would want, but we're not creating our plan. We're creating your plan. So have some peace. Be grateful that you saved what you did. Enjoy your working years. And hey, as you go through those, we'll help you make some steps to get you to the best position. But regardless, you're still going to be in a great position in retirement, even if you still have to deal with those risks. It just means maybe your beneficiaries won't get as much money, and that's okay too. The money's for you, not for them.
And Dave, I think it's a great story because I think what you're illustrating is not number one, every plan is different. And number two is that you're helping them to get to their retirement, not yours. Because I feel like so many times we're trying to fit them into a plan that we already have prepared for them versus saying, okay, let's figure out what your plan is. Let's figure out how to help you get to retirement, because it's easy to say, let's do this at age 70, everything's going to work out. But what you're saying is in this situation, it doesn't work out, and you have to be able to cater to what her needs are and help her to get through it for her level.
And you're exactly right. And the path doesn't always have to lead down the same road. If you look at it yourself, your son's been doing extremely well in track. Congratulations. He broke some records. I think that's very exciting, that have been there at the high school for decades now. But if you look at where you guys have traveled throughout Utah, there's multiple roads to get there. Now, if we're looking at the fastest road, yeah, there's one fastest. But you know what? Southern Utah's got some beautiful scenery. I may want to go out of my way and take an extra hour so I can see some other things, so I can enjoy Zion. Maybe I want to go out and enjoy Bryce Canyon, all of these beautiful places. It's a lot like retirement. Yeah, there's a road that we're going to give you that we say, yes, here's a perfect road, but it doesn't have to be the only road. There's a lot of ways to get you to retirement. And the most important one I will tell you is the one that you can emotionally deal with, that you're going to be happy with, that you're going to feel comfortable with, because you're the one that's going to have to live with it every day.
Yeah. Yeah. And I appreciate that. Dave, let me ask one question that came in from Amanda. She's asking how pensions factor into this.
So the biggest problem we have with pensions, and again, I don't hesitate to say a problem with pensions because it's great if you have one, is it's a guaranteed stream of lifetime income that is going to cause your Social Security to be taxed forever. So you're going to have provisional income forever. So what you've got to do is you've got to reduce or all of your money out or eliminate all your money from your tax deferred account, because any additional money you have in there is going to be added on above your pension, above your Social Security. And then you're going to have that at your top bracket, whatever that may be. So we want to move that money out. The standard guidelines of saying you could have up to 250 for a single or 500,000 for a married couple and a tax deferred account, that all goes out the window if you got a pension, if you got rental real estate that's throwing off income. All those things are going to affect how we plan for your retirement.
Yeah, not everyone has access to this. And so those are one of the questions that I wanted to bring up, just because I feel like pensions, we've talked about several times on the show and on the podcast. Not everyone has access to pensions anymore if they're around, but it's one of those things that if you do have it, we want to make sure that we're answering your question and getting you prepared also.
Yeah.
Dave, I want to bring up as we end here, Gary brought up one question. It's kind of more of I guess we're going to get your thoughts here. But House Ways and Means Committee just passed legislation to phase in an increase in the required minimum distribution age to 75. What are your thoughts? Legislation will go to the full House for passage.
My thoughts are they're doing exactly what they need to do to create taxes in the future. I mean, again, think about it. If you're in an environment where taxes are going to be substantially higher in the future, why not do just what they're doing? They're pushing it back. They're giving you 3 years, and many retirees think this is great. But remember two things: 40% of retirees have to take those distributions to live. Well, that's the poor segment of the population. If you have to take it out, it's because you have no other money. So 40% have to take it out, 60% don't, which are the richest people. They're letting it set in there longer. Yes, you're not taking it out currently, but that means you've got larger distributions, which is going to put you in a higher tax bracket. It means they're kicking the can down the road, which means more money is going to be in a higher tax bracket in 2026 when rates go up. And it means there's a chance you would have more money to be able to kick out to your kids a higher tax bracket. So I'm not sure if I were doing the planning for someone, I would still not take distributions out. Again, you'd have to run the math on it. But if I'm the government, hey, you know what? Let's tell retirees they can wait till 80 and then let's jack the taxes up to double what they are. And we get all of our money and they think we did them a favor. I think it's just smoke and mirrors to some level.
Yeah. Dave, you also have a lot to say about what's happening right now with all of this on your Facebook page. And I always think it's fascinating because we're seeing so much change right now, but it's not always, like you said, they're just basically kicking the can down the road. And eventually it's going to come to the point where we have to take care of this today.
Yeah, I was just reading CR. They finally got the 2020 trustee reports out for Social Security and Medicare. Social Security, they're giving some recommendations talking about how tax rates need to go up. And I talk about it in my podcast this week. They need to go up about 4%, just over 4%. That could fix the problem indefinitely. Or you've got to cut benefits down about 25%. So you could take those two drastic measures or do a combination of both and add some other things into it. Medicare, they're begging the government to take care of this problem. At 2026, by that point, it's going to be broke. And they're saying, look, it's a bigger problem than Social Security. You guys won't touch this. You just keep kicking it down the road. And again, the longer you kick it, the bigger problem you have, the more debt you add to it, the bigger problem you have. And at some point, inflation and costs are going to create major issues. So we've got to try to do our best to take care of these. Tax rates are going to be an issue because the government's going to have to continue to provide, or again, they're either going to increase taxes or going to take out your benefits. So both of those are going to hurt retirees financially. We've got to do our best to help prepare people for that period of time.
And Dave, I love how much passion you have for this. I mean, these are the things that why we are doing what we do. And I really appreciate you taking time to come on and answer all these questions and be able to take comments from Mike and Gary and be able to come on and just talk about retirement, because these are the topics. The more we talk about it, the more action we take. The less we talk about it, the more we tend to, again, kick it down the road, or we put it somewhere else and say, I'll deal with that later. And that's causing more and more issues, not only for the government, but for ourselves. And I think every day we do this, I think we get a little bit closer to trying to achieve our own goals, to getting closer to retirement.
I feel like we do. And it is passion for me because I look back at my own life. The other day, I was reading letters from my mother that she wrote to me when I was a missionary, back when I was 19, 20 years old. And one of those letters talked about, I was trying to get into a college. And so I was having her try to do some paperwork for me. My parents had never gone to college, so they didn't know how to do it. So I'm trying to get them to do the papers. Well, in one of those letters, something had happened and she had not bought me something that I had wanted. And I don't know what it was. I think it was a computer or something that I was asking her to buy. So when I got home, it would be available. And she goes, I didn't want to buy you that computer because you only have a couple $100 left. And I wanted you to have that for when you start college. Well, see, we were broke. I did start college with a couple $100. And I worked my way through it. My parents never gave me $1 through that process. I educated myself and completely changed my life within really about 10 years. When I look at my 5 years in school, by 5 years in my career, I was making great money. My family was in a really great position. And I look at that with retirement. Look, you may be in a bad situation now. You may be in a position where you shouldn't be. But through education, you can change that. And yeah, it may take you a decade. Maybe you're 65 and it's going to take you to 75. But if you live to 85, hey, you added 10 great years of being in a better position than you otherwise would have had. And that's really my goal. I want you to have better lives. And I'm not saying money solves the world's problems, but it can take a lot of worries out in retirement if you manage it correctly, so that you don't have to wake up every morning wondering if you're going to run out of money before you run out of retirement.
Dave, I love it. I'm so thankful that you're here and again answering all these questions. And I hope that passion rings through for those who are watching. Again, thank you for being here. Thank you for sticking through these 30 minutes with us. And again, if you have retirement questions you didn't get to ask today, go ahead and submit them over at theprosperityguy.com. There is a contact tab where you can send your question there. And always, Dave, they can join you on webinars. They can listen to your podcast. They can watch this replay, or they can go back over and enjoy it on LinkedIn. We have a great show. We answer a lot of questions there as well. So get the education you need. As Dave is saying, it's so important to educate yourself. But if you're watching this and you want to help your clients, that's another story where you got to go back through and help teach them the proper ways as well. So that's a key piece that we talk about and teach about through these concepts also. But again, thank you for being here. And Dave, thanks for taking time out of your day.
You're welcome. Glad to be here. I will tell everyone too, today we have our first 1.5 hour reverse mortgage class. The truth about reverse mortgages. If you've wanted to better understand them, encourage you to go to our website, get signed up for that. We'll have future classes, but this is going to be the initial launch of this class as I go into a deeper dive of what reverse mortgages are.
Yeah, in fact, I've had a couple calls already that came in asking because they're ready to sign up and they're just that eager. So they call and say, "Hey, let's get me signed up." So again, you just go to the website, you'll follow the links there, and we'll get you over to that class for the reverse mortgage. Again, everyone, thank you for being here. And Dave, I'll see you in person next week.
Yeah, okay, sounds good. I'm excited.
All right, thanks everyone for being here, and we'll see you guys again next time.